Hello, I'm Eric Christensen, and thank you for joining us for this webinar. I'm joined today by Frédéric Ducolombier, ESG Director at Scientific Beta, who is going to tell us more about reconciling low carbon and multi-factor investment. Hello, Frédéric. Thank you for joining us. Factor investing in the equity space is increasingly popular, and given the urgency of climate change, so is low carbon investing. This brings the need to combine the two, and as many investors in factor strategies have noticed, this is particularly challenging since factor strategies often have higher carbon impacts than cap-weighted benchmarks. Some providers claim that the best solution to this problem is to integrate low carbon analysis into the financial analysis, thereby blurring the lines between the drivers of financial performances and the means to fight climate change. We will explore today in more detail how lower carbon objectives can be reconciled with factor investing, and also why there is a need to keep the two objectives separate. If you have a question during the webinar, please submit it through your interface, and we will try to answer them before the session is over. Over to you, Frédéric.
Thank you, Eric. Yes, like you said, there is significant relevance of decarbonizing multi-factor portfolios. But before I look at the numbers, I just mention what are the forms and motivations of decarbonization programs. Decarbonization may refer to the reduction in the carbon footprint or the exposure of the portfolio to carbon risk, or the reallocation of capital in a manner that aims to support the transition to a low-carbon economy. The motivations of decarbonization can be altruistic or self-interested. The main investor objectives typically are reducing the exposure to climate change risks, reducing the climate impact of investment, and contributing to the transition to a low carbon economy. As you said, it can be quite challenging for a multi-factor index, and as we see on this table, the figures are pretty disappointing. Value and low volatility tilts result in increased exposure of multi-factor indices to carbon-intensive sectors and companies, and this has a detrimental impact on carbon metrics, as you see here. Relative to the cap-weighted benchmark, our standard multi-factor index has 85% higher weighted average carbon intensity, 66% higher weight of carbon-related assets. If you look at carbon footprinting metrics, which measure the indirect impact on climate change of your investments, carbon intensity is almost 50% higher, and carbon footprint is double for the standard index. So pretty scary figures, and the challenge is then to reduce this not only to the level of the benchmark, but possibly beyond if we are to decarbonize the investments. Yeah, let me tell you about the design of this option. This option first is applicable across the Scientific Beta flagship multi-factor offering and can be combined with other risk options like sector neutrality or market beta adjustment, for example. While preserving the objectives of the flagship indices, the option aims to reduce the index exposure to transition risks based on three approaches. Negative filter that removes companies with significant coal involvement, a positive filter that removes companies with high emissions relative to their revenues, which is called carbon intensity, and an adjustment mechanism that mitigates the short-term deviations from the long-term decarbonizations in the portfolio. So the divestment from these high transition risk companies contributes to increasing their cost of capital. So there's pressure that is put there, and it incentivizes transition by these and other companies. So you are making a difference in that manner. It also promotes lower indirect climate impact from index investments, as we shall see. The decarbonization mechanism centers around exclusionary filters that are applied upon the universe as a first step before we start building the multi-factor index. And this is done in a manner that does not allow financial considerations to impact the filtering. So we filter based on carbon considerations. We do not let financial considerations change the choice of securities there. Then within this green universe, the focus is on the exploitation of scientifically validated source of financial performance, the usual factor tilting and diversification of idiosyncratic risk that you find in our smart multi-factor methodology. At the very end of index construction, on a very conditional basis, there is this assurance mechanism that looks at the potential shortfall between the targeted decarbonization in the long term and what is achieved in any given quarter, and does some very minute adjustment. And these adjustments are kept very small to protect the index characteristics, the financial characteristics of the index. Let me walk you through the 3 decarbonization approaches we have built in the low carbon option. First, there is a negative filter targeting companies with significant coal involvement. We target coal because it has a very high climate impact. It's amongst the widely used fossil fuels, the fuel that has the highest emissions per heating unit, so it's inefficient. And at the same time, it's very widely used. 30% of global emissions are due to electricity production with coal. So it's a very significant contributor to global warming. And if you want to take a risk view, then coal assets, notably reserves and long-lived coal-fueled industrial equipment, such as power generation units, have high stranding potential. This is because in any transition scenario, if you take a 1.5 degree Celsius transition scenario, the median reduction in coal use is 85% over the next 30 years. And for energy production, we're talking about 96% reduction in the coal use. So it's total obliteration of coal. So in terms of risk, you might want to consider this in your portfolio. And that's what we do with this coal filter. We consider coal industry companies, companies that own coal reserves, companies that have revenues from involvement in coal in excess of 30%, and also power generating companies that have more than 30% of their power generation capacity explained by coal. So that's the first step, the first filter. Then the second filter is a positive filter that targets the removal of high carbon intensity companies. This is because obviously transition goes beyond phasing out coal, and the transition risks are not concentrated in the coal value industry. The second decarbonization approach is a positive filter that targets the removal of high carbon intensity companies. And this is because we recognize that the transition to a low carbon economy goes beyond phasing out thermal coal, and that, of course, transition risk pervades key transition sectors and affects companies in all the sectors potentially. So what we do here is to spend 10% of the size of each geographical block in exclusions targeting carbon intensity, and we remove stocks in each block from worst carbon intensity to best carbon intensity. This is performed with sector controls. We limit the maximum number of removal in a sector at 50%. And by targeting carbon intensity, we are promoting a reduction in the weighted average carbon intensity of the portfolio as well. Excluding the companies with the highest carbon intensity from the universe does promote a reduction in the weighted average carbon intensity of the portfolio, but it does not guarantee it. So the first two decarbonization mechanisms are filters, and there is a number of benefits with this exclusionary approach. By removing companies with high coal involvement, we cancel the exposure to companies that may face particularly high stranding risks. By removing companies that have the highest carbon intensity, we cancel exposure to these companies that may be disproportionately exposed to transition risks. and this is more conservative than targeting an average intensity in the portfolio, which assumes that there's a linear relationship between intensity and risk. With our flexible best-in-class and sector caps, we balance efficient diversification with sector protection, and we try thus to preserve the sources of multi-factor performance. And all the exclusions are performed on security level ESG characteristics, so that sends very straightforward signals to issuers and stakeholders, and that also applies the highest possible pressure on targeted companies, which contributes to increased cost of capital. So there are great benefits to the exclusionary approach, but it cannot guarantee the weighted average carbon intensity of the end index. That's because we build the smart multi-factor index downside of the screening, and we let factor characteristics and diversification characteristics determine the weightings. So to protect the long-term strategy against challenges in respect of the weighted average carbon intensity, which is the metric that is recommended for reporting by asset owners and asset managers, we have included a weight adjustments towards the end of index construction to guarantee that the decarbonization of the portfolio in terms of weighted average carbon intensity is significant in any given quarter, stays close to the long-term average. So this is meant as a conditional adjustment mechanism that is rarely triggered, and it's kept minimum in terms of changes to the index to preserve the financial characteristics of the index. For example, this mechanism has been rarely triggered. The region in which it's been most often triggered is the United States, and you see that over the last 10 years it's only been triggered 5 or 6 times out of 40 quarters. So this adjustment mechanism is triggered when the weighted average carbon intensity of the index falls short of a reduction of 35% relative to the benchmark, and we adjust the weights on a sectoral level to target the reduction of 40%. On top of these decarbonization filters and adjustment, the low carbon option embarks a do no harm feature. So it's a set of negative ESG filters in respect of very consensual ESG issues anchored in norms that ensure that the search for financial performance and decarbonization of the portfolio is not allowed to undermine ESG norms. So we cover controversial weapons, tobacco, violations of fundamental ethical norms, and violation of shareholder rights. Now, this is the design. What are the impacts in terms of decarbonization, ESG risks, and financial performance of this option? Naturally, by design, the negative ESG filter and cold filter will remove the exposure to the controversial conducts and the controversial products above the tolerance levels that we have defined. So it's not surprising to see that all the issues that were flagged out and screened out are disappeared from the low carbon index. So you can see there's no longer any anti-personnel mines or cluster bombs, no longer any tobacco in the index, and the coal industry has been removed. The amount of power generation utilities with coal capacity over 30% has been dramatically reduced. We moved from 2% in the index or 4.5% in the multi-factor index without low carbon filtering to 0% in the low carbon option. Now, if we focus on the carbon metrics of the index, we see that there is a dramatic improvement in the emissions-based metrics, and there we are looking at performance over 10 years, whereas the standard index had 85% higher carbon intensity, weighted average carbon intensity than the benchmark. We see a reduction of over 50% for the low carbon option. And you see the same type of reduction in the sector neutral version of the index. In terms of footprint, we also see some very significant reduction in the numbers, whether you look at the carbon intensity measure, which is falling by 50% relative to the benchmark, or the carbon footprint measure, which is falling by over 1/3 relative to the benchmark. Now we've seen what is the impact on ESG performance and carbon metrics. What is the impact on financial performance? We've excluded a moderate number of stocks. The core ESG filter that includes coal and the do no harm issues removes less than 5% of the stocks in the universe, and then the carbon intensity targets removal of 10% of the stocks from the universe. There's a bit of overlap between the two. In total, we remove about 14% of the universe. But there is a sector protection that is active to maintain the diversity of sectors, and therefore the factor intensity and the decorrelation potential from having a variety of sector. We perform the exclusions within block to avoid geographic bias. We have a very limited amount of stocks excluded, and the weight adjustments that we perform very infrequently are also kept to a minimum to make sure that the sources of financial value added are maintained. So let's look at these sources now. These are tables looking at the factor expression over the last 10 years and in a 7-factor model. And what we see here is that the total intensity from the different popular factor tilts is unchanged or slightly improved by filtering. So there is nothing here suggesting that the ability to harvest factor premia in the universe is affected negatively by filtering, especially when you control for sectors. You see that there is not much difference between the factor expressions in the standard index and in the low carbon index. So the factor exposure dimension of performance is preserved. If we look at diversification and observe the GLR measure, that is a ratio of the variance of the portfolio to the average variance of the stocks in the portfolio, we see that there is a significant reduction from diversification that's observed in the standard index, and that we have about the same amount of reduction for the index that's been built on a low carbon filtered universe. So there too, no suggestion that this traditional source of performance, that is the diversification of the non-rewarded risk, has been affected. In total, when we look at the performance of the indices over 10 years, we do not see much differences. If we focus on the non-sector controlled index, there seems to be a slight improvement of performance in the low carbon option relative to the standard index. Now, this is linked to the fact that the universe has fewer utilities that are a source of low volatility and lower beta. So the index is a bit less defensive, and it's a 10-year period with strong performance, so you're picking up more of these returns over 10 years. So the outperformance here is linked to these sector differences in the index. And when you control for sector differences by applying the sector neutral option on top of the low carbon option, you see that the difference in performance between the standard and the low carbon option indices is well, about non-existent. So there was nothing to suggest that the sources of performance were affected, and when we look at the actual performance over 10 years, there's nothing suggesting that there's a cost for lowering the carbon exposure of the portfolio. By way of summary, the low carbon option has achieved outstanding decarbonization of the index investments. First, if we look at the indirect contribution to climate change, the carbon footprint metrics, carbon intensity is about halved over 10 years. Carbon footprint is reduced by 1/3 relative to the benchmark. If you think in terms of support to transition, the exposure to coal assets and high carbon intensity companies has been materially reduced. And of course, the exposure to transition risk has been severely limited, as testified by the weighted average carbon intensity of the index that is halved relative to the benchmark over 10 years. So very significant decarbonization relative to the benchmark. And as you may remember, we started not at the benchmark, but at the level of multi-factor indices that were far more impactful in terms of carbon and far more risky in terms of exposure to the transition risks than the benchmark. So excellent decarbonization there. This decarbonization has been achieved without impacting the traditional sources of performance in the index. So the factor intensity is preserved and the diversification is preserved as well. And when we look at the risk-adjusted performance of the index, we don't see any significant difference between the traditional multi-factor indices and the low-carbon indices.
Okay, thank you, Frederick. Now let's see if we have some questions. Okay, so first question about Scope 3 emissions. So do you use Scope 3 emissions in your index, and what do you think about Scope 3 data quality?
Okay, well, for the audience, Scope 1 refers to the emissions directly controlled by the company, the emissions from its operations. Scope 2 to the emissions that are related to the purchases of electricity, cooling, heating by the company. So they are indirect emissions for the company. And then Scope 3 refer to all the other indirect emissions across the value chain of the company, so both upstream and downstream. So as you can imagine, it's difficult for a company to estimate what are the emissions of its suppliers and its client. So very few companies are required to report Scope 3 emissions. And there's very little voluntary reporting of Scope 3 emissions. Also, Scope 3 emissions have multiple items. Very few companies report across all items. So the data is scarce. It's not very comparable. Altogether, you can't use self-reported Scope 3 data for your analysis. So there are some data providers out there that perform sector-based estimates of Scope 3 emissions for companies, and we rely on data provided by ISS ESG that is doing a very good job at that. But these are sector-based estimates. It would be improper to base security selection or carbon screening on data that is more related to the sector. You can't really tell a company from another. So we don't use Scope 3 at the screening stage, but we recognize that Scope 3 emissions are of interest, and therefore in all our reporting we include not only carbon metrics computed based on scope 1 and 2 emissions, but also on total emissions that include scope 3. So you will find this in the carbon reporting section of the website.
Okay, thank you, Frederick. So now let's take another question. So you exclude companies with poor climate performances. Shouldn't you also favor companies that offer climate-friendly technologies or solutions?
Yeah, okay. Well, the bulk of the investment opportunities in this space are in private equity and infrastructure. Opportunities in large and mid-cap public markets are limited, and favoring them in the context of a wide interest index could create some liquidity issues. I think a thematic index to be used as a satellite by the investor, and possibly a quite concentrated satellite, would make more sense rather than to seek to overweight these stocks in the context of an index that's supposed to be, if not the core of your portfolio, very close to the core of your portfolio, Eric.
Okay, thank you. So let's wrap it up. We believe low carbon investing should be, and perhaps foremost be, about tackling climate change and reducing climate-related risks. But the good news is that this can be reconciled with factor investing without losing any of its benefits. For more thoughts and detail on the topic, please consult our white paper, which is available on our website, scientificbeta.com. Feel free to send more questions to webinar@scientificbeta.com. And lastly, please follow us on social media. We are present on LinkedIn, Twitter, and YouTube. Thank you for watching today, and goodbye.